Hello, ladies and gentlemen, boys and girls. Welcome back to Harvesting Income channel. I've been off for a while due to personal reasons and also taking a break from my work and the videos. And great to be back again. And today I'm going to talk about a recent topic that's been online, especially on YouTube and social media. It's about MSTE, which is the Harvest Microstrategy Enhanced High Income Shares ETF. What's so special about that? Yeah, of course, it's the strategy company that the fund invests in, and they give a high level of income, pretty attractive yields, and so on. But the news that we are talking about is people losing hundreds of thousands of dollars. And if you are one of them, you have to watch this video to understand, the fund, how it works, and what's going on. Uh, the big gurus, the big experts who have been, talking about this fund have invested in the fund and lost hundreds of thousands, and they're also posting videos showing the same. That's good. That it's good to have good information. But why is this happening? I'm sure most of you who are regular harvesting income viewers, you may not have done that kind of a decision because this is a poor decision in the first place. And I'm going to explain that. I'll explain to you about the fund, the strategy, and finally I'm going to share the key takeaways. So feel, be sure to stay till the end to get the full picture and how you can avoid these kind of, mishaps. And it's not just a roller coaster ride. You're actually playing with fire and losing your hard-earned money. And none of those gurus or experts are going to come to save you. You know, let us get started with that in mind. And anything I say here is not investment recommendation, not a financial advice. It's purely for knowledge purposes and learning. Okay, the fund name is Harvest MicroStrategy Enhanced High Income Shares ETF. The fund has this name MicroStrategy on its the fund name, but the name of the company is Strategy as of now. They invest in Bitcoin. They do a lot of technology-oriented business. Plus, also have a treasury where they invest in the Bitcoin. So even my familiarity with the company is pretty, moderate. So that's one of the reasons I don't invest in single stock or what call ETFs or even any other single stock ETF for that matter. Okay. What is the investing strategy? Okay, they invest in the strategy company. They hold those shares, the Class A shares. The ticker symbol for the company is MSTR. Most of you are familiar with that. And the fund writes covered call on half of the portfolio, which means that the fund owns a certain number of shares. On 50% of those shares, they would write covered calls to generate regular income, just like a typical covered call fund. Sounds good so far. Now, the third part is pretty interesting. That's where you have the double-edged sword, which is the leverage, 25% leverage for higher income and growth. The fund is going to borrow money, and that is going to enhance the fund's ability to buy more, generate more income, or generate more growth by investing more in the same stock. So it's just like buying a stock. You're buying a stock because you believe in the future prospects of the company, fundamentals, and future growth in the business and so on. And you believe in the management too. So what is happening here is like you are investing in one stock, not a basket of stocks. I always recommend investing in a basket of stocks. That's the whole purpose of investing in an ETF. So now you invest in this company, and hopefully the fund will write covered calls to generate income. They have been doing that pretty well. And the fund is also tracking the price of the stock, price of the company, or the performance of the company. So when the performance is down, it's going to leverage on the downside as well. So leverage works both ways. It's just like a double-edged sword. On the positive side, it can enhance your returns. And similarly, when the returns are negative, it can increase your negative returns, which means increase your losses too. That's the bottom line that you need to understand. Okay, I'm going to throw in some basic information so that you can look into the fund if you're interested. The fund symbol is MSTE, listed on the Toronto Stock Exchange. Its price is about $6.91. It was in the 20s, in the past. Like, And the recent past, it came down below $10 and all the way to $6.91. This is as of November 18th. And the fund is pretty new, like launched in March 2025, hardly 8 months. So it's too early to make any judgment. And remember the fact that when you're investing in a single stock ETF, you are investing in a single company. So you are taking the risk of investing in the stock itself. You might buy the stock instead of buying the ETF. Anyway, so the net assets of the fund is 365 million, and the expense ratio, we don't have that information because it's a new fund. Management fee is reasonable at 40 basis points. So overall, looking at the basic information, it looks pretty decent. And we still need to look at the dividends and the price performance. The fee part of it is reasonable, like 40 basis points for this type of fund is pretty reasonable. And but I'm not a fan of single stock, ETFs. So I would not recommend to anybody. But if you're interested, then you're taking that risk of a single company, single stock that you are investing in. Okay, now let's go to the drama that the whole YouTube and social media is talking about. The price went down 59%, almost 60% since the fund was launched. When the fund was launched, it was about $14, $15, I think. I'm not sure. It even went close to $20, but due to the performance of the stock, you see the downfall in the price of the ETF. And you can see that it's not just the fund that fell in price. The underlying stock, MSTE, lost 56%. And the fund is underperforming the stock. A covered call fund is supposed to give you lesser amount of losses because it's supposed to give you the cushion. When the price of the underlying stock falls by 56%, you are expecting that the fund will fall lesser. The cushioning effect, shock absorber effect that I talked about. That doesn't work sometimes because in individual stocks, you have a lot of other factors coming into play. This is one of the reasons I have been telling on this channel that you should not pick any individual stocks when you're picking a covered call fund. None of the gurus, none of the experts on YouTube and all social media talk about this. And I can tell you straight away on your face. And if you're willing to take the risk of a single stock, then you're going to pay the price for that. Unfortunately, that's the risk and return you are getting for, the kind of decision that you made. You made a decision to take that risk and you may get the return on the positive side and also on the negative side. You have to take both ways. So in this case, people lost more than half their investment, 59% loss. So that's the whole drama. That's why people are talking about, oh, the MSTR is not doing well or the Bitcoin prices fell down. I get that point. Even I have personally invested in Bitcoin and I've seen these kind of volatile situations, but not in single stock ETFs because when you're investing in an asset, it's a different story. You're investing in gold or Bitcoin, you invest about 5% or 10% of your overall portfolio. So you're not going to be worried too much about the ups and downs. And that was true in my case. You're going to put all your investments or majority of your investments in Bitcoin or in gold, you are actually taking a big risk. That's why the importance of portfolio diversification and balancing your portfolio across different asset classes comes into play. Okay, let's go to the next interesting stuff, the distributions. This is more interesting because previously we saw the price falling down. But now look at the distributions of the fund. When you look at the fund's launch, like March 2025, in the beginning they gave a distribution of 60 cents. Like, I'll just use the pointer to show you where I'm looking at. And when you look at April and May 2025, they moved it up. The distribution shot up 10% to 66 cents. And then it went back to 60 cents in June, July, around the summertime. And then in August, again, you have a drop in the dividends. One point to note that I'm not trying to bash the fund or the fund manager or the strategy. These funds are meant to give you income, and the income is highly variable. It's highly volatile because the stock itself is volatile, and obviously the fund is also going to follow the stock price and the stock's performance. So if you don't understand the underlying asset, you will feel this is not correct. But I would say the distributions part is pretty much expected because it's pretty much expected in Bitcoin, pretty much expected with MicroStrategy or strategy or any other volatile asset class. You will find that the distributions are going to be highly variable. But the biggest surprise I got is the recent distribution, which is 45 cents in October 2025. This is 45 cents, all the way from 60 cents to 45 cents. It's almost like 25% cut. However, keep in mind that distributions are again variable. So I have said 25% cut because I'm referring to the initial distribution, but it's pretty much expected. So I'm not going to bash anybody here. So it's just volatile performance, or can even say the markets, because the options market can also be volatile and option premiums can be very rich at some point of time. Sometimes it can be very low. So there you have it. So distribution was cut around 25% and it's highly variable. So if you're prepared for this kind of variance, I'm okay with that. Like it's okay to have some investment in this fund, but make sure it is certain part of the portfolio that you are able to absorb that exposure to that risk. High level of risk should be, easily absorbable by your with your risk tolerance. In other words, I would say that if you're someone who doesn't like eating spicy food, you want to ensure that you're not buying something that is too spicy. You want to, tell the restaurant or the person who's making it to make it less spicy or moderate or low spice. So the same way in this portfolio, you want to make sure that the risky assets occupy a smaller portion of your portfolio. Hope that message is clear. Okay, what happens to the total returns now? So far, we're talking about price returns distributions. So on the price front, you lost about 48.8%. This is in the last 8 months since the fund was launched. And the distribution yield is about 34.6%. Overall, you lost about 14%. So the last 8 months, after listening to all the gurus and all the experts, you put your money into MSTE, you lose 14%. Even after counting all your price up and down and all your distributions that you received, you still lost 14%. So imagine you invested $100 in this fund. Today you're sitting with $86 only, including the dividends. That's the bad news. So if you're feeling very good about it, congratulations. The stock will recover, the fund will recover to some extent. The problem with the recovery of the fund is covered call funds are capped in terms of the upside. So since 50% of the fund is capped, so the upside on the 50% is going to be a little limited. But on the other 50% of the fund, which is not capped, it will move according to the stock price. So in some way, you're going to recover gradually. As long as the stock recovers well, your fund is going to slowly recover. It's not going to move as fast as the underlying stock. So the message is clear. The underlying stock is actually changing the whole climax, whole story. So what went wrong actually in this case? Simple. You did not know what you're investing in. You just fell for the marketing, the gimmicks, all these, big promises and all the fancy, logic and tips given by these great gurus. First of all, the simple solution that is know what you're investing in. If I am the guru and I'm telling you something, I'm only giving you the information or knowledge. I also always put a disclaimer saying that this could be risky. And you have to make sure that you do your own due diligence and do your research and then take a decision accordingly. Especially if you're listening to someone who is giving you tips and giving you attractive reasons to invest in something, promoting a particular stock or a fund or any particular fund house. be careful because there are channels, there are people, there are you know companies or channels promoting certain funds or certain products. You got to be careful not to follow anybody who is recommending a certain fund, and especially beware of all these sponsored videos and listen to videos which are independent, research oriented, coming out from the individual who has done his own research. For example, I am Sri from Harvesting Income. I do the research independently, look at the fund, its performance, everything from A to Z, and present you the idea. And I can also tell you whether the fund is good or not, and who it is more suitable for, and who it is not suitable for. So you should know what you're investing in. Okay, now the million-dollar question is, how many MSTE investors know about strategy, its business model, and fundamentals? I will be honest here, even my knowledge about MSTR is pretty limited. So the answer is clear. I never touched MSTE. Forget about MSTR, I never even invested in MSTE. Now, some of you may argue that, oh, you don't know cryptocurrency, you're old school, you don't know all these new digital platforms and all that. For your information, I invested in a fund named BTCY, and and that fund also lost more than 50%, and it lost a lot of its net asset value, you know, a major amount of net asset value for a couple of years after COVID, lost a lot of money. But I knew what I was investing in. And because of the high risk, I invested only a small portion of my portfolio, like 5%. So that did not affect my overall portfolio. Thirdly, I was also aware that just like gold, it's going to be erratic. The prices can move up or down. Sometimes the prices may go nowhere. Sometimes it can keep moving in the flat direction or downward direction. Anything can happen with Bitcoin too. But I was confident that I would be getting some amount of dividend every month. And I was convinced about the strategy of the fund and how the fund manager is, executing the strategy and generating the income. And I was also confident that I can reinvest those funds back into the fund to generate more income. So if you have a clear strategy, then the success or failure is under your control. If you don't have a clear strategy, you don't know what you're investing in, you cannot do anything. You just have to sell off the loss and come out of it. So do you like investing in MSTR for the long term? So that is the question that you need. That's the million-dollar question you need to answer. If you don't know the answer to this question, don't invest in MSTR, MSTE, or anything, MSTY, any other fund related to that company. Simple. And if you want to invest in a basket of crypto ETFs or tech ETFs, like in my case, I wanted to invest in Bitcoin ETF. It was risky. I did my research, I spent a lot of time before investing money into that. And I gradually increased my exposure as I did my research and got confident. So do it in a step-by-step fashion. And the other question that I wanted to ask is, do you want to invest in a basket of crypto ETFs or pick a single stock ETF? So listening to all these gurus, smart people like some of them who invested in MSTE chose to pick a single stock ETF. How many times have you heard about diversification and investing in a basket of funds, index ETFs or basket ETFs? No, I'm smart. I'm going to invest in this one because I want to make that X amount of return. That's the problem. You might make X amount of return in terms of dividend yield, but your capital is eroding. So 20% dividend yield makes no sense if you're losing 50% on your capital. Do your math. You know, 20% yield is nothing if you are already losing 60% of your capital. You are already on the negative. It is just like saying that I'm getting a higher amount of rent, but my roof and walls are falling off from my house. So how does that make business sense or investment sense? Zero sense, right? So that's why it's important to understand what you're investing in. And that brings us to the last part, which you're all been waiting for. And it's not about MSTE. Like I'm not trying to bash anybody here, but I'm just trying to put the situation in front of you so that you can understand what happened and also avoid the same mistakes in future. And these are avoidable mistakes. It's not as if you did a small mistake, you sold it at the wrong price, or you didn't buy at the lowest price and highest, you didn't sell at the highest price, that kind of thing. That's a different story. In this case, you are actually making a very basic mistake and losing your capital. And the capital is hard-earned money, hard-earned savings that took several months or years to save and invest. And you're losing it all in a few weeks or a few months. So that's the problem that we have identified. How did the MST do in the first 6 months since launch? If you have been tracking the fund for 6 months, instead of investing or putting in your money, tracking it first, verifying your facts, and then you're convinced after 6 months that you want to, take a small exposure. Take a little bit of small exposure, $500 or $1,000, or probably less, $200, depending on your budget, depending on your portfolio size. Take a small, chunk, invest in the fund and see how it performs. After 6 months, still launch. If you're convinced, if you have observed the fund performance for the first 6 months, you would not be investing in this fund in the first place, right? So that's the message that I wanted to convey. So any new fund, don't jump for it. It's not like a new iPhone. You have to jump into it. Wait for the fund to form, prove itself, and then you can invest in it. Okay, I'll focus quickly on the three pillars that I want to highlight when you want to pick any covered call ETF. Okay, I have to make some assumptions here. This is for people who are investing in covered calls for medium to long term, only for investment purpose, not for trading or anything. Medium to long term investment. And you want to invest in something that is more stable, and you're not going to pick any particular sector or a particular stock. So let's get started. The first pillar is understand the underlying stock or asset you're investing in. Okay, some of you may ask that why do I say underlying stock? I said that it's a basket of stocks. Yes, true, it's a basket of stocks. But there are some cases, for example, gold ETF or Bitcoin ETF, where you are investing in the underlying asset. So when I said underlying stock, I mean the number of stocks which are packaged into the ETF. So just to clarify, that's the basket of underlying stocks. So and you're investing for the long term, which means like at least for 3 years, or probably ideally it's for 5 years, but minimum 3 years. So in the future, you can take a call whether you want to hold it or you want to sell partially or you want to liquidate some funds for some other future plans. It's up to you. So that's the first pillar. So if you're, you know, uh, you have to understand the underlying stock. That's the first pillar. Why I'm saying understand the underlying stock, like for example, MSTE. Some of you may want to invest in single stock ETFs. I am not against it. Personally, I would not do that, and personally, I would not recommend that strategy. But if you still want to invest in the underlying stock ETF, like you want to pick an Apple covered call ETF or Microsoft covered call ETF or even strategy covered call ETF, hey, go and do that. But understand the underlying asset, which is your Microsoft or Apple or Microstrategy, any company for that matter. If you understand the underlying stock and then you're doing it, you know the risk and you're prepared for it. Like you know what you're getting into. So then the first pillar is taken care. Second pillar is a different point that I want to make. You are trying to eliminate a single point of failure, which means that you are trying to eliminate choosing a single stock. So if you choose not to invest in a single stock, you want to invest in a particular sector. Let's say you want to invest in Nasdaq ETF. Invest in a basket of Nasdaq stocks because you like the technology stocks. That's a good idea. Instead of picking one technology stock, you are investing in the whole basket. So that eliminates SPOF, which is the single point of failure. Now, that's the second pillar. The third pillar is the most important, and this is the most boring part of it. Now, you're still not invested your money, you're still doing your research and analysis. You're still not bought the fund or the ETF. You observe the performance of the fund for at least 6 months to 1 year. I'm talking about new funds which have been launched recently. So it's a pretty older fund. You can look at the past data and then take decisions. You can look at the past. numbers, your price has gone up, gone down, and you can look at the dividend distributions every month or every week, depending on the fund, and look at the performance for 6 months or 1 year. At least 6 months is recommended, but I would say 1 year is a more safer bet because there are a lot of funds which have completed 2 years or 3 years. So there's no shortage of funds. So don't try to chase the new fund, you know, because of the FOMO effect. Like you don't need to get into that FOMO. The funds are always available. There are dozens of funds which are coming up, every month. So there's no shortage of funds. So observe the performance for 6 months or at least 1 year, and then put it on your watch list. And whenever you're ready, you can start buying in small quantities. And depending on performance, you can gradually increase your risk exposure, depending on the fund, depending on your goals, depending on what type of stocks, what type of companies you want to invest in. Now, those are the three pillars. Now, the last part is just checks and balances. Check the strategy promise that the fund made and compare that strategy of the promise. The fund said that it will deliver high amount of returns, high amount of distributions. Plus, it will give you low to moderate capital appreciation. Check each and every aspect. Check whether the fund is able to give you the high amount of distributions. Yes, good. Second part, is it able to give you the low to moderate capital appreciation, like 0 to 5% capital appreciation? Yes, then it's good. Let's say the fund is able to give very high dividends, but distributions, but it's not able to give you capital appreciation. The fund's capital is coming down, like basically the NAV is falling. You put in $100, now your capital is $50, and you got $10 in distributions. So you're eroding your money. So in that case, you have to uh, quickly stop that loss and take out whatever money you have and move it to a new fund because obviously the fund is not performing well. And of course, this performance analysis has to be compared in relation to the index or the underlying stocks. So I'll do a future video on that too, how you can look at your performance and decide whether you want to exit the fund completely or you want to wait and recover some of your losses. So it's important to compare the promised strategy versus the actual returns. Funds can make good promises, but are they really delivering on those promises? That's the million-dollar question. Now, last but not the least, beware of online gurus' tips. Do your own research. Do your own research. Until you do your own research and you're convinced, don't invest your hard-earned money. If you find the research and due diligence very difficult, please don't invest. You might as well, buy lottery tickets or something else. You know, why waste time doing your research if stock market is not the place for you. So if you are going to just bet on a stock just like that, just like betting on a lottery ticket, good luck to you. You don't have to be. I don't have to be spending time explaining this to you. But if you are really serious, you want to be a successful investor. You want to learn how to invest. You want to learn how to fish rather than trying to get the fish. Like I'm not trying to give you the quick short solutions because the quick short solution doesn't work. Doesn't work for me, it doesn't work for you, it doesn't work for anybody, including the online gurus and experts. The fundamental um, recipe for success is doing your own research, understanding the markets, understanding the fund, understanding the underlying stocks and the fundamentals of it. That will drive your success, and at least it will put you on the driver's seat. And you can be the CIO of your investment, chief investment officer of your own investments. If you're not willing to do that and just throw money away and hope that some fund manager or someone is going to take care of it. No, God bless you. You're living in a different world actually. So just make sure that you can put in some effort to do your research. And if you have any questions or any feedback, anything you want to know, please feel free to drop in your comments, and I would be happy to provide answers or some kind of guidance or direction to you. I hope you like this video. And if you have any other comments, feedback, please feel free to share below. And if you like what you're watching, please subscribe to my channel or follow it. Or if you can hit that like button, it would be a great encouragement for future content and future videos. Thanks for watching. Appreciate it. Happy investing.